Hi, my name is Stephen from Share Navigator, and today I'm going to show you how to complete the profit and loss tables for the covered call strategy. So what you're looking at here is a spreadsheet that we've created for you. If you want to get access to this spreadsheet, you can download it by going to our website, sharenavigator.com, click on the courses tab, and then select the covered call strategy course. And in that course, you'll be able to download this spreadsheet. So the first section here is data inputs. Any box that's highlighted in yellow requires some sort of data for you. So, for example, we've started off here with the first data point, which is the stock name. So, for example, if you're doing a covered call on Apple, we'll type in Apple. And the current share price is about 112.46. So, you're going to get all that information from wherever you're getting your data from. And the trade date is today's date, which is November the 30th. So you can see here when we get to point number 4 here, that's automatically populated with Apple for you because the system is recognizing that you've chosen Apple. And next we get into the quantity of shares that we're going to buy here. So the first leg of any covered call is where you've actually bought the shares of the company. So you must enter multiples of 100 here. So you can't put in, for example, 125 shares or 50 shares here because with the covered call strategy, call options are bought and sold in contracts, and each contract controls 100 shares of stock. So it doesn't do odd lots as such. So we're going to type in 100 shares here, and the price we're putting in here now, this is what we're saying is the price that we actually bought the shares at, because a lot of the time when people are doing covered calls, they don't buy the stock and sell the call at the same time. They might buy the stock, let the call rally a little bit, and then sell the covered call. So let's say we bought the shares of Apple when they were at $101, so we'll just put that in there. So that's just the price that you actually purchased the shares at. So the next thing you'll come down here, leg 2 of the trade, is where we actually sell the call option. And you can see here that the quantity is automatically populated to 1 because it's recognizing that you only own 100 shares, so therefore you can only sell one call option contract. So the system won't let you put in here the wrong amount of calls that you're going to sell. The strike price we're going to pick, let's say we're happy to get out of the shares here at 115. So we can see that the shares are currently trading at 112.46, but if they got to 115, we'd be happy to sell them. So that's where you'd want to be selling your cover call at. And the expiry we're going to pick, let's say, is December the 16th. So we're happy for that. The premium on offer at the moment on that is 176. And the trading commissions, if we were to place this particular trade, will be about 70 cents. So that's what it's going to cost you to sell that call. Just work off the principle there. If you're trying to guesstimate this, about 70 cents per contract that you're selling. So our net premium received after trading commissions is 175. So the system is just taking into consideration here the fact that you have a trading cost here as well. So the net premium from your call is reduced from 176 to 175. The great news for you after that, you don't have to input any more data. Everything else is calculated out for you. So let me go through some of the data. Our max loss in this strategy is still considered to be unlimited because if the share price continues to fall below the break-even point, your losses continue to accumulate. Your profit, however, is limited, and our max profit potential with this particular trade we've put in here is 1,575.30. And this is achieved when the share price at expiry Friday is above $115. Our break-even price is $99.26. So any price above that and we'll make a profit on our Apple shares. And our total investment is equal to our break-even price multiplied by the number of shares that we own. So as you sell covered calls on your original stock position, you're always reducing your break-even point. So that's one of the benefits of the strategy. So our possible return on investment is 15.87% on this trade if the share price finishes above 115. So we've put in here some important notes on the trade. So first of all, we've created profit and loss tables. So we would encourage you to watch this video through and understand what the profit and loss tables mean. And the second thing to note is this is a really good income generation strategy for people who own stock. Too many people own shares of companies, maybe through their stock options that they got working with their companies, or maybe it's something that has been given to you or you've bought through the years. And if stocks are trending sideways, which they tend to do nearly 80% of the times, you can be selling call options against that stock position and generating a monthly income. So it's a great strategy for that. And it's great for total beginners in option trading. It's one of the first strategies you should start getting yourself used to. But you should only apply the covered call when the stock has reached your target price or is trending sideways. If you are bullish on a company, you should use a different option strategy. You should switch to something like the bull call spread or maybe the bull put spread, because this strategy is considered neutral. And the reason it's considered neutral is that your gains are going to be capped once the share price hits a certain level. So moving on to our profit and loss tables. So what we've done here is created what if scenarios at expiry. So we're saying here, well, what if the share price of Apple went to 91? What would that mean for us in terms of profit and loss? What if they went to 93? What would that mean for us in terms of profit and loss, and so on and so forth? So the first thing we put on here is the profit from our stock position. So as you know, we've bought the shares here of Apple at, we've put in here at a price of 101. If the share price obviously has dropped to $91 and we own 100 shares, well, we're down $10 by 100 is down $1,000. At 93, we're down $800, and so on and so forth. So that's just the profit from the stock if the share price at expiry is trading at one of these levels. Then we need to put in that the net income we've taken in for actually selling the call. So remember, when you sell a covered call, you're taking in option premium. That's going into your cash account. So no matter what happens to share price at expiry, that money has gone into your account and is yours to keep. But then we have sold a call option, and that's going to have some sort of value at expiry. So remember, with call options, they only have value when the share price is trading above the strike price or when the call option is in the money. So you can see here, because we sold a $115 call, there's no value in this call option at expiry until the share price gets over 115. Then at 117 you see a minus 200 here. So why is it a minus? Well, we've obligated ourselves to sell our shares at 115. So if the share price is at 117, obviously that call option contract has $200 of value in it, but it's not our value. We sold that call option contract, so it's a negative for us. And we do that for every potential outcome. So all we're doing then here for our profit and loss at expiry, we're simply adding up these three columns here, and anything that's highlighted in red is a loss. So if the share price goes to $91, we lose $824.70. If it goes to 99, we lose $24.70. And then you're going to see on the profit side here, again, highlighted in green, if it's a profitable trade, you can see that it's continued to rise until it gets to a certain level here. At 115 and above, our profits are capped. So that's why we say it's a neutral strategy, because you're not benefiting anymore when the share price starts rising above the 115 level. So the plus side of the covered call, you're taking in a credit for agreeing to sell your shares at a certain price, and it's reducing your break-even point. The downside is if the share price jumps and continues to rise, you're going to have to sell at 115. So just look at what that looks like on a graph format. You can see here, you can see as the share price is rising here, your profits are rising. Then we get to 115 here, and you can see our profit amount is capped. So that's what it looks like from a graphical representation. So at this stage, it's a great idea for you to start practicing trading options. If you're a member of Share Navigator, practice the covered call strategy in your simulated account. If you're not a member of Share Navigator, you should become a member. We will give you a simulated trading account so you can practice trading these strategies in a risk-free environment. Even better, at the end of every month, we pay out cash prizes to our members who have the best returns for that particular month. So you can win some money as well through your simulated trading account. It's a great way for you to go and learn how to trade options.